Hello, everyone. Thank you so much for joining us today. We are so excited to share information about the final rule for the State and Local Fiscal Recovery Funds program with you. And we are very much looking forward to continuing to work with you to implement this program. Let's see. For now, I'd like to turn it over to Jacob Liebenluft, the Chief Recovery Officer at the U.S. Department of the Treasury.
Thank you so much. And I want to begin by just thanking all of you for joining us today at this webinar. Congress provided Treasury with a crucial tool in the state and local fiscal recovery funds to support state, local, territorial, and tribal governments on the front lines of responding to this pandemic. But this funding would never have been available had it not been for the advocacy of so many governments and so many staff like those of you on the line today. And since passage of the American Rescue Plan last year, you have all been critical partners in implementing these funds. We know that the work that you have been doing has been literally life-saving, helping people in your communities stay protected and recover from an unprecedented pandemic. And we know that this work is especially challenging during such a pandemic. On behalf of the Treasury Department and the entire administration, I want to acknowledge and thank you for that work. I also want to thank you for the feedback you have provided us during this process. Participants in this program range from the largest states to the smallest towns, counties, and tribes, with a wide diversity of needs and capacities. We have benefited greatly from your input as we prepared the final rule in order to maximize the impact of these funds. Let's turn to the next slide, please. Before we get started, I want to provide a quick disclaimer that we are summarizing the final rule today. So naturally, we won't be covering all the details, and we encourage you to read the rule itself and the final rule overview available on our website. I would also note that Treasury does not, as many of you know, pre-approve specific projects. The final rule provides clear direction about what kinds of projects are eligible uses of state and local fiscal recovery funds. And we have provided additional resources, including a user-friendly guide to the final rule to help recipients navigate the rule. We also anticipate issuing additional FAQs and guidance as we receive questions from governments like your own. As you digest the rule, we welcome those questions and will of course keep you updated as we provide further resources. Next slide, please. I want to begin by offering a brief overview of the objectives of this funding and how the program has been implemented so far. As you know, the State and Local Fiscal Recovery Funds program provides $350 billion in support for state, local, and tribal governments, which constitutes historic relief for communities across the country. The goal of our program is to provide governments with the resources to achieve three crucial purposes. First, it offers the resources to fight the pandemic and support families and businesses struggling with its public health and economic impacts. Second, it allows governments to maintain vital public services amid declines in revenue resulting from the crisis, avoiding some of the devastating cuts that we experienced coming out of the last recession. And third, it provides governments with the tools to support a strong, resilient, and equitable recovery by making investments that support long-term growth and opportunity. Next slide, please. Let me share with you a little bit of our progress so far on those three goals. Treasury has paid out more than $245 billion to governments so far, accounting for over 99% of the funds that are currently available. Many of these funds going to communities that had not previously received federal assistance since the onset of the pandemic. And under the terms of the Interim Final Rule released last year, recipients have already taken significant actions to meet immediate pandemic needs and invest in a strong recovery. This slide contains a few examples of how recipients have already used state and local fiscal recovery funds to make important investments responding to their local needs. Recipients are, for example, supporting the public health response, including by building capacity in ways that help them adapt nimbly to new variants like Omicron. For example, by expanding access to rapid testing, supporting robust vaccination efforts, and taking other steps to protect those at risk in their communities. Governments are taking vital steps to strengthen the economic recovery with programs that help people get back to work, keep people in their homes through rental assistance, or provide grants to small businesses that were impacted by the pandemic, in addition to enabling state, local, territorial, and tribal governments to avoid budget cuts and layoffs. And recipients are making longer-term investments in areas like sewer and water infrastructure, or by expanding high-speed broadband, addressing a need we've seen among so many who are trying to learn, work, and connect during the pandemic. Now, in parallel, as states, localities, territories, and tribes have been taking action under the Interim Final Rule, Treasury has been extensively engaging with stakeholders over the past few months through over 1,500 public comments that we've received on the IFR, thousands of questions, and many meetings with governments like your own to hear feedback about what has been working well in the initial program design, as well as things that stakeholders felt could be improved. And today, we're going to talk about a little bit of that, describing the final rule with a particular focus on some of the elements that have changed since the IFR. To do that, I'm going to turn over next to my colleague, Kitty Richards, who is the director of the State and Local Fiscal Recovery Funds, and who, along with members of her team, Andy and gang, who have been crucial in developing this final rule, will provide an overview of the rule and begin a deep dive into it. Kitty, turn it over to you.
Thank you so much, Jacob. So before we describe the final rule's provisions in detail, I want to note that the final rule takes effect on April 1st, following the requirement that significant rules must be published at least 60 days prior to their effective date. However, if a use of funds complies with the final rule, Treasury will not take action to enforce the interim final rule, regardless of when the funds were used. This means that recipients can take advantage of the expanded flexibilities in the final rule now, instead of having to wait until April 1st. In addition, as you know, recipients were encouraged to begin using funds under the interim final rule, and thousands of jurisdictions have done just that to invest in important recovery projects. Treasury wants to reassure our recipients that funds used consistently with the interim final rule, both previously and until the final rule takes effect on April 1st, are in compliance with the program. For further questions about the applicability, please consult the statement regarding compliance with the IFR and the final rule on the Treasury website. So as a reminder, under the American Rescue Plan Act, funds can be used in 4 eligible use categories. First, the broadest eligible use of funds is to replace lost public sector revenues. Funds can support general government services up to the amount of revenue loss due to the pandemic. Second, recipients may use funds to respond to COVID-19's public health and negative economic impacts. Third, recipients may provide additional support through premium pay to essential workers who bear the greatest health risks because of their service in critical sectors. And fourth, recipients may invest in necessary water, sewer, and broadband infrastructure. Within these 4 eligible use categories, the final rule has added some core elements intended to improve the flexibility and simplicity of the program in line with feedback from recipients. First, Treasury has greatly simplified the program for small localities, many of whom have received historic federal relief through this program, by allowing recipients to elect to claim a flat standard allowance of $10 million in revenue loss rather than completing the full revenue loss calculation. This change will allow a large share of recipients to use their full award for general government services with streamlined reporting and tracking. Second, Treasury has broadened the list of eligible uses specifically included in the rule that recipients can use to respond to COVID-19 and its economic impacts, equipping states and localities to adapt quickly and nimbly to changing public health and economic needs, including the Omicron variant. This includes clarifying that states and localities may use funds for capital projects to respond to pandemic impacts. This includes, for example, to build affordable housing and job training centers, as well as hospitals and schools designed to serve disproportionately impacted communities, consistent with Treasury requirements described in the final rule. Third, Treasury has also streamlined the provision of premium pay by broadening the share of essential workers who can receive premium pay without additional written justification. Fourth, Treasury has expanded eligible water, sewer, and broadband infrastructure projects, understanding the unique challenges facing each state and locality in delivering clean water and high-speed broadband to their communities. Let's dive further into each of these eligible use categories and the new elements of the final rule related to them. First, I'll cover the eligible use of replacing public sector revenue loss. As a reminder, this is the most flexible eligible use category, as recipients can generally spend these funds on any service traditionally provided by a government up to the amount of their revenue loss. Under the IFR, recipients were required to calculate revenue loss according to a formula. The final rule instead provides an option for recipients to either use that formula or elect a flat standard allowance of revenue loss up to $10 million. The standard allowance amount is based on an analysis of average state and local revenues across the country and dramatically simplifies the program and eases administrative burden, particularly for cities and towns that may have limited administrative capacity. Electing the standard allowance does not increase a recipient's total award amount. For example, if a recipient has a total award amount of $9 million, they may spend up to $9 million on government services if they elect the standard allowance, but their total award size remains that $9 million. Recipients may still choose to calculate revenue loss according to the Treasury formula, which, as a reminder, compares recipients' actual revenue to a counterfactual trend. In the final rule, this formula has two new major elements. Recipients now have the flexibility to calculate revenue loss on either a calendar or a fiscal year basis. And further, in order to more accurately reflect revenue loss that is due to the pandemic per the statute, recipients are required to adjust actual revenue totals for the effect of tax cuts and tax increases that are adopted after January 6, 2022. Further details on all of this are provided in the rule. After determining their revenue loss in one of these two ways, governments can spend broadly on any service traditionally provided by a government up to their revenue loss amount. Examples of these government services range from road construction to provision of public safety services to schools, with the exception of items specifically prohibited, such as pension deposits, contributions into rainy day funds, and for states and territories, using funds to directly or indirectly offset a reduction in net tax revenue that results from changes in state or territory law. I'll now hand it over to my colleague, Andy Taverna, Senior Advisor to the Chief Recovery Officer, to speak about the second eligible use category, responding to public health and negative economic impacts.
Thank you so much, Kitty. As Kitty just mentioned, recipients can also use funds in many different ways to support their public health and economic response to the pandemic. This includes several subcategories of eligible uses: responding to public health impacts, assistance to households, small businesses, and nonprofits, aid to impacted industries, and support for public sector capacity and workforce. In general, to identify eligible uses of funds in this category, recipients should first identify a public health or economic impact of the pandemic on an individual or class of individuals, and second, design a response that addresses that impact. To provide simple and clear uses of funds that meet this standard, the rule provides a list of dozens and dozens of eligible uses that respond to the pandemic's impacts. The rule also presumes that some populations were impacted by the pandemic and are automatically eligible to receive these services. In other words, recipients choosing to provide services that Treasury has enumerated as eligible to any of the presumed eligible populations are clearly operating consistently with the final rule. Recipients can also identify and respond to other pandemic impacts by providing other services or serving other eligible populations based on the standards provided in the rule. We'll now walk through each of these eligible use categories in turn. Let's start with public health. As you know, the pandemic remains an imminent threat to public health, and recipients have very broad flexibility to use funds to support their COVID-19 public health response, allowing them to adapt quickly and nimbly to changing public health needs like the Omicron variant. As you can see in this slide, Treasury provides an extensive set of eligible responses in the public health eligible use category that recipients can undertake without undergoing any additional analysis. Specifically, first, recipients can use funds for COVID-19 mitigation and containment, including vaccination and testing programs, mitigation steps to safely keep schools and businesses open, protection of congregate facilities, and many other eligible uses. Second, recipients can use funds to cover medical expenses incurred due to the pandemic. Third, in recognition of the significant impacts of the pandemic on mental health and substance use, recipients can use funds for a broad range of prevention, treatment, harm reduction, and recovery services for behavioral health. Finally, fourth, recipients can use funds to prevent and respond to violence, including increased gun violence, through programs like community violence intervention programs. Importantly, the final rule also clarifies that certain capital expenditures, like ICUs, emergency rooms, and behavioral health clinics, are eligible to respond to public health impacts if they meet the rule's other requirements, which we'll preview shortly. Moving on to assistance to households, recipients can use funds for a broad set of eligible uses designed to help households affected by the negative economic impacts of the pandemic. This will help orient you to the structure of eligible uses to address negative economic impacts more broadly. As I noted above, the final rule identifies certain populations that are presumed to have experienced pandemic impacts, as well as a list of eligible services to respond. This slide addresses populations that are presumed eligible for services. Eligible households and communities are split into those impacted on the left-hand side of the slide and disproportionately impacted on the right-hand side. Impacted households experienced widely shared impacts of the pandemic that affected many Americans. Disproportionately impacted households experienced meaningfully more severe impacts than average and are eligible for an even broader range of services to address both those more severe impacts and the disparities that cause them. To simplify administration, Treasury has expanded households and communities presumed eligible, which allows recipients to provide services to them without additional analysis. Impacted households include those that experienced unemployment, food or housing insecurity, or participate in certain other federal programs as displayed on the slide. I wanted to draw your attention to one specific aspect. The final rule continues to presume that low and moderate income households and communities were impacted by the pandemic and now provides a specific definition of low and moderate income. Low and moderate income is defined as households at or below 300% of the federal poverty guidelines, which is about $65,000 per year for a family of 3, or at or below 65% of area median income. Treasury also newly presumes that low-income households and communities were disproportionately impacted by the pandemic, along with other types of households listed on the right, including households in qualified census tracts. Treasury's definition of low income is at or below 185% of the federal poverty guidelines, about $40,000 per year for a family of 3, or at or below 40% of area median income. On Treasury's website, we have published an easy-to-use tool for recipients to look up applicable income levels in their communities for these definitions. Outside of these presumed eligible households, recipient governments can also designate on their own any household or class of households that experienced an impact or disproportionate impact from the pandemic, including identifying impacted households at higher income levels. Recipients can do this using data or other sources of information about their communities. Turning now to Once recipients have identified an impacted or disproportionately impacted household, they can pursue programs, services, or capital expenditures that respond to those impacts. This slide shows some of the dozens of eligible uses specifically included in the final rule for impacted households on the left and disproportionately impacted households on the right. Because disproportionately impacted households experienced not just pandemic impacts, but more severe impacts, they're eligible for all of the services listed on both sides of the page. As you can see, eligible uses include a huge range of services, everything from food assistance to job training to lead remediation. and Treasury has clarified in the final rule many additional eligible uses. Importantly, in response to recipient feedback, the final rule makes some services available more broadly than under the interim final rule. Specifically, affordable housing development, childcare, early learning, and services to address learning loss for K-12 students are now eligible uses for all impacted populations, not just those disproportionately impacted. This includes certain childcare facilities as well, which many recipients had expressed interest in. The final rule also adds a number of eligible uses for disproportionately impacted households and communities, which provide an opportunity for recipients to invest in projects that can address the disproportionate effect of the pandemic on historically underserved populations, as well as the longstanding inequities that cause those more severe impacts. Several key additions include improvements to vacant or abandoned properties as an eligible use, as well as certain community development and neighborhood revitalization activities. Certain capital expenditures in health clinics, hospitals, and schools are also eligible in disproportionately impacted communities if they meet the rule's other requirements. Finally, I wanted to note again that recipients can identify other services that respond to the pandemic's impacts beyond those listed here. Turning now to assistance to small businesses. Similar to assistance to households, recipients should first identify an impacted or disproportionately impacted small business and can then provide responsive services, including from a list of eligible uses identified by Treasury. In the final rule, Treasury clarifies that recipients can consider various indicators to designate an impacted small business, including lost revenue, financial insecurity, and increased costs, as you can see on the left-hand side of the slide here. Impacted businesses can then receive loans or grants to mitigate financial hardship, as well as technical assistance and other business planning assistance. On the right-hand side, you can see that Treasury presumes that small businesses operating in qualified census tracts, among others, were disproportionately impacted, and that a broader set of capital expenditures and services are responsive, such as rehabilitation of commercial properties, startup or expansion assistance, and support for microbusinesses. Again, recipients can also identify additional small businesses as disproportionately impacted as long as they meet the final rule standards. Recipients can also provide assistance to nonprofits, which proceeds in a very similar fashion as assistance to small businesses. Again, to identify impacted nonprofits, Treasury provides flexibility for recipients to consider a number of different impacts, such as decreased revenue due to lower donations or increased costs due to increases in service need. Recipients may provide loans, grants, or technical assistance to these impacted nonprofits. Turning to the right-hand side of the slide, nonprofits operating in qualified census tracts, among others, are presumed disproportionately impacted, and recipients can identify responses that address the disparity that led to that disproportionate impact. I also wanted to highlight the final rule elaborates on the difference between working with small businesses and nonprofits as beneficiaries, which means providing assistance to them based on the impacts of the pandemic that they experienced, and working with small businesses and nonprofits as subrecipients, which means having a nonprofit or a small business carry out an eligible use on behalf of a recipient government, often through a grant or a contract. In addition, recipients may also use funds to provide aid to industries impacted by the COVID-19 pandemic, such as travel, tourism, and hospitality. Recipients should go through 2 steps to do so. They should first designate an impacted industry, and second, provide aid to address the industry's impact. Treasury has provided a few ways to designate an impacted industry. First, the travel, tourism, and hospitality sectors are identified in the statute as impacted. For industries outside these sectors, recipients can make a simplified test, which would designate an industry as impacted if it experienced at least 8% employment loss from pre-pandemic levels, or if it is experiencing comparable or worse economic impacts as the national travel, tourism, and hospitality industries due to the COVID-19 public health emergency. Recipients may then provide aid to address these impacts, which includes supporting payroll or other operational costs, as well as technical assistance and COVID-19 mitigation. Note that because this aid is responding to the pandemic's impacts, eligibility is limited to entities operating prior to the pandemic and affected by efforts to contain it. Finally, recipients can respond to pandemic impacts experienced by the public sector itself. Treasury recognizes that public sector capacity is critical for both the economic recovery and for maintaining vital public services in your communities. There are three main categories of eligible uses to support and bolster public sector capacity. First, the final rule allows for states and localities to cover payroll and covered benefits for public health, public safety, and human services staff for the portion of time spent responding to COVID-19. Second, in the final rule, Treasury has provided a broader menu of options for states and localities to restore and support their public sector workforce. This includes hiring public sector staff up to 7.5% above their pre-pandemic workforce levels to make up for underinvestment since the Great Recession. This also includes providing funds to employees that experienced pay cuts or furloughs, using funds to avoid layoffs, and providing retention incentives to public sector staff. Third, the final rule clarifies how funds can be used to support more effective service delivery, including use of evidence and program evaluation, as well as addressing administrative needs caused or exacerbated by the pandemic, like adapting government to remote operations. Finally, I wanted to highlight an eligibility standard that applies across all of the subcategories within public health and negative economic impacts. One of the most frequent questions we received from recipients was on the eligibility of capital expenditures, meaning investments in property, facilities, and equipment. In the final rule, Treasury has clarified that recipients may undertake capital expenditures consistent with the rule's requirements under the public health and economic response eligible use category. Capital expenditures are subject to the same eligibility standard as other uses to address the public health and negative economic impacts of the pandemic. Specifically, they must be a related and reasonably proportional response to an impact of the pandemic. For capital expenditures equal to or above $1 million, recipients other than tribal governments are asked to complete a written justification to substantiate that they have met the eligibility standard. The written justification requests information that recipients likely already have as part of their decision-making process, namely why a capital expenditure is appropriate and why the proposed capital expenditure is superior to alternative capital expenditures. For example, a recipient building a new facility should compare the costs and benefits of doing so as opposed to other options like renovating an existing facility. This approach strikes the balance between allowing for capital expenditures that provide long-lasting benefit while also ensuring that these projects are responsive to the pandemic's impacts. Depending on the size of the capital expenditure, recipients may also have to submit the written justification to Treasury as part of regular reporting. Although just like all other eligible uses in the program, recipients do not need to go through a pre-approval process with Treasury. Treasury has included in the final rule a list of dozens of eligible capital expenditures, as long as they meet the requirements in the final rule, including the written justification if applicable. As you can see on the bottom left-hand side of the slide, this ranges from testing labs to childcare facilities and emergency response equipment like ambulances. Treasury has also presumed that some capital expenditures are generally ineligible. This includes the categories on the bottom right-hand side of the slide, specifically construction of new correctional facilities as a response to an increase in the rate of crime, construction of new congregate facilities to decrease spread of COVID-19 in the facility, and construction of large capital projects such as convention centers or stadiums for general economic development or as aid to impacted industries. Further, note that capital expenditures must still respond to an impact of the pandemic. Treasury has maintained in the final rule that transportation infrastructure and general infrastructure development does not generally respond to an impact of the pandemic and therefore are not eligible capital expenditures. As I just outlined, Treasury has provided a list of dozens and dozens of specific uses that are eligible and populations presumed to have experienced pandemic impacts or disproportionate impacts, who are automatically eligible to receive responsive services. This is meant to provide simplicity for recipients and a broad, easy-to-use menu of ways to use funds to support your community without having to do additional analysis. Recipients providing enumerated uses of funds to populations presumed eligible are clearly operating consistently with the final rule. However, recipients are not restricted to these enumerated uses or presumed eligible populations. Recipients may invest in eligible uses outside of those listed as specifically eligible by Treasury. To do so, recipients should engage in the same simple two-step analysis as under the Interim Final Rule. First, they should identify a COVID-19 public health or economic impact on an individual or class of individuals, meaning a group. Recipients can also identify disproportionately impacted individuals or classes. Second, recipients should design a project that is related and reasonably proportional to addressing the identified impact and is reasonably designed to benefit the impacted individual or class. The final rule substantially elaborates on these standards and how recipients should apply them to determine eligible uses. While recipients can design additional projects, I would like to note again that Treasury is not able to pre-approve specific projects. I will now hand over to my colleague Geng, a senior advisor in our office, to talk through the remaining eligible use categories.
Thank you very much, Andy. I will now move on to the next eligible use category, our third of fourth categories, which is premium pay. Now, Treasury has expanded ways in which recipients can provide premium pay for essential workers who bear the greatest health risks because of their service in critical sectors. Recipients need to undergo 3 simple steps before providing premium pay, which include, first, identifying eligible workers in critical infrastructure sectors, which include the professions that you see on the right of the slide, ensuring that they engage in regular in-person interactions or physical handling of items handled by others, and third, ensuring that the pay responds to worker needs. Now, this includes providing pay to lower income workers, defined as those earning at or below 150% of average annual wages, or new to the final rule, to workers that are not exempt from the Fair Labor Standards Act overtime provisions. When providing pay to other workers, recipients must submit a written justification of how the pay responds to essential worker needs. So in essence, the final rule provides an additional streamlined way for recipients to provide premium pay without having to fill out a written justification. And finally, Treasury has clarified that premium pay can be provided in many different forms, in installments or lump sums, and to a very wide range of workers. And as a reminder, premium pay can be up to $13 an hour, up to $25,000 per worker during the life of the program. Now, I will move on to the next eligible use category, our final eligible use category, which is infrastructure investments in water, sewer, and broadband. Starting with water and sewer, in the final rule, Treasury has broadened eligible infrastructure projects, understanding the unique challenges facing each state and locality in delivering clean water. Specifically, under the IFR, the projects that were eligible under the EPA's state revolving funds, those that are on the left of the slide, were eligible under this program. These are an extremely broad set of eligible uses that support clean drinking water, safe treatment of wastewater, water conservation, and improved water quality. And specific eligible projects range from construction of publicly owned water treatment plants to lead service line replacement. However, we've also heard from recipients about additional particular needs in their communities for other types of necessary water and sewer infrastructure. So under the final rule, in addition to the projects eligible under the SRFs, which are on the left, Treasury has also added new categories of eligible projects, which are on the right, which include a broader set of lead remediation projects, including faucets, fixtures, and internal plumbing in schools and childcare facilities, additional types of stormwater infrastructure, such as culverts, residential wells, and certain dam and reservoir rehabilitation. Now, moving on to broadband, as we all know, the pandemic has revealed that access to high-speed, affordable broadband is a necessity for modern life. And as such, recipients may use funds to build broadband infrastructure to address needs in their local community. such as lack of access or affordability. So after taking into account feedback from stakeholders and recipients, Treasury has significantly broadened eligible areas for broadband investment, which is shown as number 1 on the slide. And under the final rule, recipients are encouraged to invest in locations without wireline reliable speeds of 120, but have flexibility to identify areas with a need for additional broadband investment. And this need may include lack of access to high-speed broadband, as well as lack of affordable access or issues with the reliability of current connections. And this flexibility complements funds available to states and other localities under the Infrastructure Investment and Jobs Act, which are targeted toward unserved and underserved locations without access to high-speed internet. And second, recipients are still required to deliver high-speed service of minimum 100 symmetrical speeds unless impracticable, which will ensure that networks funded by this program are long-lasting and meet the day-to-day needs of households. Third, a new requirement in the final rule mandates recipients to require service providers who provide service to households to either participate in the FCC's flagship low-income subsidy program, the Affordable Connectivity Program, or a comparable program. And this will ensure that networks funded by this program are equitably accessible to those across the income spectrum. So in sum, the final rule allows for affordable, high-quality broadband investments that complement the IIJA. And further, the final rule also allows recipients to invest in cybersecurity investments in broadband networks, regardless of service delivery standards. We have now touched upon all the eligible uses of funds. As you can see from this conversation, the final rule provides greater flexibility in uses of funds, as well as greater simplicity. And the final rule also maintains and clarifies some restrictions on use from the interim final rule. So first, states and territories may not use funds to directly or indirectly offset a reduction in net tax revenue resulting from a change in state or territory law as required by the statute. Second, for all recipients except for tribal governments, funds may not be used for deposits into pension funds as required by the statute. Importantly, though, these deposits are defined as certain types of extraordinary contributions. So recipients can still provide routine payroll contributions to pensions of employees whose wages and salaries are an eligible use under this program. And finally, for all recipients, funds may not be used for debt service, to replenish reserves or rainy day funds, or to satisfy a settlement or judgment. And further, funds cannot be used to undermine COVID-19 mitigation practices in line with CDC guidelines and recommendations, or violate the Uniform Guidance conflict of interest requirements or other applicable laws. Now, one of the areas that we've received a number of questions on is on the use of state and local funds to meet non-federal match or cost sharing requirements in other federal programs. And the final rule clarifies the eligibility of this use of funds. First, Treasury has determined that funds available under the revenue loss eligible use category generally may be used to meet the non-federal cost share or matching requirements of other federal programs. However, note that state and local funds, including under the revenue loss category, may not be used as the non-federal share for purposes of a state's Medicaid and CHIP programs. Second, state and local funds beyond those available under the revenue loss category may not be used to meet the non-federal match or cost share requirements of other federal programs, other than if specifically provided by statute. So for example, the IIJA specifically provides that state and local funds may be used to meet the non-federal match requirements of authorized Bureau reclamation projects and certain broadband deployment projects. So for recipients who are interested in using funds in that manner, more details can be found in the final rule. We wanted to end with a quick note on reporting during this transition period between the interim final rule and the final rule. As you know, the first project and expenditure reporting deadline is on January 31st, which applies to states and territories, certain metro cities and counties, and certain tribal governments, as you can see on this slide. These recipients should rely on the reporting guidance and the user guide issued by Treasury to complete their January 31st reports. And just by way of overview, the user guide details a few changes to reflect the final rule, including information around any capital expenditures as part of the public health or economic response, an option to calculate revenue loss by fiscal year, recipient standard allowance election, as well as changes reflective of the increased flexibility under premium pay. And Treasury will be providing reporting webinars in the near future. We also understand that recipients may need to make subsequent updates to reports that they've previously filed, including this one. And so recipients submitting a January report may update their report during the next quarterly report in April if they wish to do so. Now for reports due April 30th, which applies to all recipients, including smaller recipients that will be submitting their first annual project and expenditure reports on that date, Treasury will be issuing additional reporting guidance ahead of that date. I'll now turn it over to Kitty Richards, who has a few closing remarks before we get into the Q&A.
Thank you, gang. I just wanted to reiterate how much we appreciate everyone's hard work on behalf of their communities during this unprecedented crisis, and how glad we are to be supporting all of the good work that you're doing with this rule and with the state and local fiscal recovery funds. Namratha, can I turn it over to you for Q&A?
Absolutely. Thank you, Kitty. Our first question is, when can recipients get their second tranche? Jacob, would you like to take that question?
Sure. So the answer is a little bit different for states and for distributions to localities. So the final rule provides that for states whose payments were split into two tranches, that we expect to make all second tranche payments available beginning on May 10th, 2022, which is 12 months from the date that funding was first made available. States may receive their second tranche after submitting the second certification, regardless of when their initial certification was submitted. Now, for counties, metropolitan cities, and for state funding in order to distribute to NEUs, the second tranche is, according to the statute, the American Rescue Plan Act, available no earlier than 12 months after the first tranche was paid. So based on the legislation, that payment will come 12 months after the first tranche came last year.
Thank you, Jacob. Our next question is, I am interested in electing the $10 million flat standard allowance for revenue loss. Do I get $10 million of revenue loss each year or in total? Kitty, would you like to take that question?
Happy to. So the $10 million standard allowance is for the total period of the program, not on an annual basis. So the jurisdiction would have a total of $10 million in revenue loss. And again, electing the standard allowance doesn't increase your total award amount. It just allows you to use that award amount up to $10 million very, very flexibly without engaging in the rest of the revenue loss calculation.
Great, Kitty, thank you. All right, our next question is, I'm interested in using funds to purchase emergency response vehicles such as fire trucks and police cars. Is this eligible under the final rule? And for this question, we'll go to Andy.
Thanks so much, Namratha. There are two eligible use categories where these vehicles may be eligible. First, as Kitty outlined, recipients can spend funds attributed to revenue loss, either the $10 million standard allowance or their calculated revenue loss, on government services, which is generally considered to be any service traditionally provided by a government. This includes provision of emergency response and law enforcement services, including purchase of these vehicles. Second, and separately, purchase of these vehicles may be eligible under the public health and negative economic impacts eligible use category, as part of a jurisdiction's response. as long as the use is reasonably proportional to the pandemic's impact and is consistent with Treasury's capital expenditure requirements.
Great, thank you so much, Andy. And our next question is, it seems like the final rule allows for capital expenditures under public health and negative economic impacts eligible use category. Does this mean I can build roads and bridges? And for that question, we'll go to Gang.
Great, that's a great question. Thanks, Namrata. So the final rule maintains the approach in the IFR that general infrastructure projects, including roads, streets, surface transportation infrastructure, would generally not be eligible unless the project responded to a public health or negative economic impact of the pandemic. However, it's important to note that recipients may use funds up to the amount of their revenue loss, which is under the final rule, either up to $10 million or their calculated revenue loss on government services, including general infrastructure development.
Wonderful. And another question, under the final rule, it seems like Treasury presumes that low-income households are disproportionately impacted and low and moderate households are impacted by the pandemic and able to receive assistance. Treasury defines this with regard to the federal poverty guidelines and area median income. How do I look up what the thresholds are for my community? And Andy, can you take this one?
Certainly. So Treasury provides an easy to use spreadsheet on our website where recipients can look up the thresholds in their specific communities. But let me take a moment to step back and elaborate on how the low and moderate income presumption operates in the final rule. As you mentioned, low and moderate income households are presumed to be impacted by the pandemic and therefore eligible for responsive services. Treasury defines both low and moderate income based on the higher of either a federal poverty level threshold or area median income. For the vast majority of recipients, the federal poverty level threshold will be higher, and using it will presume that more households are automatically eligible. The area median income threshold is primarily relevant for jurisdictions with high incomes and high cost of living. Treasury defines moderate income as at or below 300% of the federal poverty line, which is about $65,000 per year for a household of 3. We define low income as at or below 185% of the federal poverty line, which is about $40,000 per year for a household of 3. Now, I've just provided levels based on a default size of a household of 3, which is used in the final rule. However, the federal poverty level differs based on each specific household size, and the final rule makes clear that recipients can use the level corresponding to the size of the household that they're planning to serve. The rule also makes clear that recipients can either measure income based on a household, specific household, if they're planning to provide a service that reaches individual households, or based on the average in the community, if they're planning to provide a service that reaches a general community instead, like a park, for example. To summarize, recipients can always presume that households earning at or below $65,000 per year were impacted by the pandemic and are eligible for responsive services, and recipients can always presume that households at or below $40,000 per year were disproportionately impacted and eligible for responsive services. However, if you want to get more nuanced than the default levels I just gave you, as I mentioned, our website has a spreadsheet where you can very easily look up the applicable levels in your community for specific household sizes.
Great, thank you so much, Andy. And we have one question which is actually similar to what a lot of you are asking around eligible uses. So this one I'll give to you, Gang. What's the easiest way to know if an expenditure is an eligible use of the state and local fiscal recovery funds?
Yes, that's a great question. So in the final rule and the overview to the final rule document, which is a very helpful, easy to use guide to the final rule, Treasury provides a list of dozens of specific uses that are eligible uses of funds and the standards that are applicable. Just to start, I think an easy way to go through is to go through the sections of the overview document, and in each section that you'll find expenditure types with check marks next to them, which are eligible uses. I'll note that, Since the overview document is just a summary, please consult the final rule text for more details and requirements about these uses. But the overview document is a great starting point. One reminder is in the eligible use category of public health and negative economic impact, which is the second one that we covered today. Recipients aren't restricted to the uses that Treasury lists out. Recipients have broad flexibility to identify and respond to other public health and negative economic impacts of the pandemic beyond the enumerated uses, as long as they meet the final rule standards.
Great, thank you so much, gang. All in all, the final rule provides a broad set of tools to enable communities across the country to adapt and respond to the public health and economic challenges from the pandemic and spur a strong and equitable long-term recovery. Treasury is committed to working with recipients to help digest the final rule and effectively maximize their use of funds, and encourages recipients to engage their communities in considering how to deploy the remainder of their funds. Treasury has also released an overview of the final rule, as we've referenced throughout Q&A, which is a user guide that boils down the rule into an easy to understand summary, including a comprehensive list of projects, as Gang described, that recipients can undertake with these funds without doing additional independent analysis. We will continue to work with recipients to navigate any remaining questions that they may have about the final rule so they can deploy these resources into their communities with confidence and anticipate issues. We anticipate issuing additional FAQs and guidance. Thank you so much, all of you, for joining us today. We look forward to working with you, and that ends this webinar.